Ladies and gentlemen, welcome to the Indiana Optometry Town Hall with expert presenters Shelley Jackson and Bob Greising of the Krieg DeVault law firm. Shelley and Bob will each speak for 20 to 30 minutes, followed by a 30-minute question and answer period. A recording of this webinar and the slides will be available in a day or two on the IOA website. Thank you for participating and supporting organized optometry. Speakers, you may begin.
Well, thank you, David. For voice recognition, this is Bob and not Shelley. Shelley, you want to offer up your voice recognition?
Hi there, everyone. This is Shelley Jackson. Look forward to presenting with Bob and talking with you today.
Yeah, so hopefully you have the screens available to you, and if not, why don't you just punch something into the Q&A section, and we'll try to help you as we can. This is me. I've been doing this for a while, but over the past few weeks, one of my primary focuses have been on what's going on in the COVID world, and in particular with the recent adoption of the CARES Act, how that comes into play. We'll be covering quite a bit of that today. We have received a number of questions in advance, and we will either address those in our remarks directly, or if not, we'll defer those until the Q&A at the end. And then, Shelley, you want to talk about yourself a little bit?
Sure. Hello, everyone. Like I said, my name is Shelley Jackson. I'm a member of Krieg DeVault's Healthcare and Labor and Employment Law Practice Group. I'm coming to you today as a member of the firm's COVID-19 task force and really concentrating on employment law sides of things. But I routinely have been involved since this has started with helping navigate various issues that come up under both state and federal law. And so I'm looking forward to sharing some information with you today, responding to your questions, and hopefully giving you a little bit of additional information from the employment law perspective.
Thanks, Shelley. And in all good lawyerly ways, we've got to give our disclaimer that this is general information and we can't, at this point, give you specific individual advice or legal opinions. So, but we are going to try to be helpful with you and offer up our views on what you present to us. And also a little bit of a commercial for us. We do have this task force that Shelley mentioned. We have a COVID resource center. You can find that on our website, www.kriegdevault.com, and it'll jump right out at you when you get on there. So I'm going to start this off with the area of interest, dealing with at least the thing that seems to be most interest these days with the CARES Act for small businesses anyway, is how do I get some money which ultimately could be pre-money? Under the Paycheck Protection Program, through the stimulus bill itself, one of the things that Congress agreed upon and the President actually signed was a way to help assure that small businesses are able to maintain headcount and maintain payroll. And so they've put together a big pool of money, $349 billion, to make that available to those who are considered to be small businesses so that they can use it for a fairly limited range of purposes and have a lower interest rate than they might be able to get. And also, if they use the dollars for those purposes, that they can get that loan forgiven. And the program kicked off a couple days ago. Actually, last Friday was the first day for submission of applications. And then the program will no longer have funds available by after June 30th. However, it is, and I'll touch on this a little bit later, once the money's gone, unless Congress takes further action to expand that dollar amount, it will be gone. It's not weighed and will allocate to everybody that applies. It's a first come, first served. And some of these things that I see here on the screen about the size, we'll talk about that as we go through this. But generally, you have to have under 500 employees to be considered a small business for this purpose. And so here's what you do if you haven't already done it. One loan per employer. So the application will tell you that ask you to certify that you're only going to borrow under this program once. I mentioned the first come, first serve, so that means you apply now. We received some information this morning, as a matter of fact, that with all the applications that were submitted on Friday, nearly $6 billion of that 349 has already been included in applications that were submitted on Friday. That number actually was a little bit lower than I was expecting. The current estimates is that right now, based upon those trends, that this pool will basically be used up by sometime in early June. I would have thought by the end of April. So, but I still encourage you to get in. For some of you, as we understand the makeup of this association, a number of you may be sole proprietors, or even some of you may be independent contractors. And the date on which applications can first be made for that class of borrower is April 10. So if you fall into that, you would not have been able to apply yet, but you ought to target this coming Friday. And this program is being managed under Section 7A of the Small Business Act. And so that program has been around for a long time. And the way in which that is administered is for the Small Business Administration to authorize financial institutions to serve as their their gatekeeper. So you need to apply to an SBA lender. And that'll be different than another program where it is being administered by the SBA itself. And on the screen, I show the application source, and I don't know if you'll get this deck or not, but if you just go on it and search for SBA PPP loan application, you'll get hits pretty readily. So if you haven't seen one yet, you should be able to get that pretty quickly. And so what are the terms? The maximum amount that you can borrow under this program is 2.5 times your average payroll, but not more than $10 million. I also reference there plus an amount under the emergency injury disaster loan. Economic injury disaster loan. We'll touch on that in a little bit. Interest rate is 1%. Some of you may have heard of some fussing going on between the government and the banking industry. The Act allowed interest up to 4%, and the banks thought that would be a good thing for them. And it came out initially at 0.5%, and they moaned and groaned, and in the spirit of compromise, they settled on a 1% per annum amount, feeling that would be enough to cover costs and give a little bit of margin for the banks, given some of the other sources of funds. Maximum of 2 years. The Act, again, said 10 years. You may have seen that in some of the early coverage. But the SBA determined that for these purposes, and given what they believe to be a short-term impact on the COVID situation, that businesses should be sort of back to normal and able to repay these within 2 years. Payments start on a deferral basis, so you don't have to pay anything for 6 months. A couple of big changes from the 7A program is that you are not required to give collateral. You're not required to give a personal guarantee. And there is something called a credit elsewhere requirement, which is waived. That credit elsewhere requirement is that the SBA was setting itself almost as a lender of last resort, that if you could find money elsewhere, you should get it there first. So, but that is waived. So it's from that standpoint, they lowered the barriers to access to these funds. And so one of the important things here is, how do I calculate what that is? How much can I borrow? You determine your total payroll for the last 12 months for U.S.-based employees. So for most of you guys, that won't be a problem, but for some companies, they may have employees resident overseas, and those are not permitted borrowers. And also, if you have some highly compensated individuals, you have to exclude anything over $100,000. You can include the first 100, but not amounts over. And when calculating that, the guidance that's out there indicates that this is sort of all sort of cash income to an employee, salary, wages, commissions, and tips. Divide that by 12 to get your monthly average and multiply by 2.5. And then also add some amounts under the EIDL program that you took up in the last few months, really as a recognition that that was probably a COVID-based emergency. And then how can you use the money? There's a big push for payroll priority, but there are 4 categories that have been identified, payroll being one of them. Interest on pre-existing mortgages, they had to be in place as of February 15th. Rent on leases in place before February 15th, and then utilities, sort of the same thing. The idea being that you can't put something in place right now and sort of game the system. But the policy that was reflected in this allocation, 75% for payroll and 25% for the others, was identified in the SBA's guidance that came out, something called the interim final rule. So interim and final are sort of interesting, but the rulemaking process takes a long time, and they expedited that, so they're calling it an interim final rule. The secretary of the administrator of the SBA determined that for policy purposes, we wanted to get money into pockets of employees, and so you had to use at least 75% of the proceeds for that. And that'll be important when we talk about loan forgiveness, which will come up a little bit later. So a couple keys on being eligible for this. I mentioned the 500 employees. You need to be small, and that's one of the ways that the SBA measures this. That number for some industries is larger, but I think for the healthcare industry, it's still at the 500 is the best number. Full-time and part-time each count as one employee. It is not a full-time equivalent calculation. And if you use independent contractors, those are not employees, and they are not, their payments to them are not part of your payroll costs for this purposes. But the thought being that independent contractors have their own ability to get proceeds under this program, so you don't need to double up here. And then when you're figuring out your employee count, I think for most of you this may not be an issue, but you also need to aggregate all of the employees under an affiliated group. So parent-subsidiary relationships, entities that are controlled by managerial levels, what I call economic collaboration, that the interested parties are always working together, family groups that may have separate entities but are collaborating. And then the SBA also preserves this sort of totality of circumstances, sort of the old duck test. If it quacks like a duck and walks like a duck, it's probably a duck. And so they, when they're trying to determine if you're small, they want to make sure that they take into account that the business is small. It's not just an organizational approach that a large company takes to divvy up its business sectors. So, again, for most of you, I don't think that would be an issue or a challenge, but you need to be aware of that. And then here's the real sizzler for why this is working and why this is of interest to a lot of people. This, in essence, could be considered to be free money. You borrow it, and if you do the right thing, you don't have to pay it back. It is forgiven. And that includes the full amount of the principal and any interest that you pay as part of that accrues. Given the deferral and given the timing, it's unlikely that you will have actually gone out of pocket for these things. There is an 8-week window, so you need to use it up for these purposes within the first 8 weeks after the loan is originated. So you make an application, and that process should be pretty quick because that decision-making is delegated to the lenders. And I know there was a question that came to us about documentation, which I'll get into in a little bit. But because of the delegation, lenders can make that decision very quickly. and then the administration is intended to fund those commitments. So use it up quick within 8 weeks. Use it up for at least 75% for payroll and not more than 25% for those other 3 categories of non-payroll. And if you don't live up to sort of the policy objectives of the program, the amount that can be forgiven will be reduced sort of on a proportional basis. So if you have actually laid people off, which is contrary to the objectives of this, and there are a couple of questions that also came up that deal with decisions that have already been made, and I'll touch on that in a moment. But if you had 100 people and over this period of time when you're seeking forgiveness, that number fell, then you will be, then the amount that can be forgiven will be reduced. So you will have some amounts that are going to get repaid after that. And then also for some of you that sounds like you have already laid some people off, if you rehire them before June 30, then that helps you. That would not be considered a reduction. And so you would then be able to avoid this diminishment in your debt forgiveness. And also the other thing you can't do is to decrease wages or salary. And again, some of you indicated that I think that has happened here. But you can't reduce wages and salary by more than 25% for those employees who are making less than $100,000. Not to dwell on that part, but if, for example, you had somebody making $150 and you reduced their salary to $100, that would be okay. But for somebody that's making $75,000, well, let's make the math easier, that's making exactly $100,000, you can reduce them, but you can't reduce it below $75,000 in that case. And then you ask your lender about it. And then these are being fully guaranteed, so the lenders will not mind that, and they'll be covered by the amounts that they've expended. And then another real positive here, some of you may have been exposed to this, but there's a concept in the Internal Revenue Code that if you have debt that is forgiven, that's considered to be taxable income. And the CARES Act expressly provides that it will not be considered taxable income for the amount that is being forgiven. So that's a very helpful feature. So real quickly on the question about documentation, and maybe we'll have to elaborate on that, but somebody expressed some concern about the level of detail that the lenders were asking. And the lenders do still need to validate your eligibility for the amount that you requested. And so they will need you to provide payroll information to confirm that the amount that you're asking matches up to the payroll that you've incurred in the past. And then they're also, we know that they're also asking for some basic documentation, like copies of articles of incorporation if you're incorporated and so on. But these requests, at least from what we are seeing, are significantly diminished from what would have been required in the 7A program under other circumstances. And so the lenders have a much higher level of due diligence, and these notes are usually sold off into the secondary market, and they need to qualify to be eligible for those secondary markets. And so there's a fairly rigid due diligence requirements in order to make sure that those notes will be eligible for sale. Those have been minimized here, and they've been alleviated. And so the requirements, while they may seem heavy and onerous and asking a lot of questions, I can probably give you comfort that they would have asked a whole lot more but for this program. So hopefully whoever asked that question is listening, and hopefully that's responsive to that. Real quick overview on the economic injury disaster loans. This program's been around for a long time. It's the program that is used for, natural disasters like Hurricane Katrina and the wildfires and floods and all that. When you hear the president declare a disaster area, or when you hear a governor say, well, we're going to declare the state of Indiana a disaster based upon remember last year we had all that heavy rain, and our farmers couldn't get in the field, so they received some ability to designate that as a disaster, and that made people eligible for these loans. One of the differences here from the Paycheck Protection Program is that these are losses that have occurred. Under the Paycheck Protection Program, you just need to certify that your business is really being adversely impacted by what's going on, which is a relatively low bar for most businesses these days. There might be some that aren't. If you're manufacturing hand sanitizers, you probably are not being adversely affected. But for others, if you have suffered a loss, then you may be able to apply here. You also still need to be a small business, and the rates are still very low. Under the statute, they're up to 3.5% for businesses, but there is not loan forgiveness. And the amount here is a little bit less. It's $10 billion, but the program extends through December 31 of this year. And you get this, as I mentioned earlier, by going to the SBA and not to a lender. And the application source is on the screen here. And again, if you do a quick search to just do EIDL loan application, it'll pop up pretty quickly. And so some of the specific terms, maximum amount is $2 million. I mentioned the 3.75% per annum interest rate. It's possible that they may come out with some guidance that would change that, as they did with the PPP loans, but uncertain. You can borrow for up to 30 years, and again, compare that to the 2-year max for the other program. And the length of time will be based upon an ability to repay. Given this program, it's possible that they would reduce that as well as they reduced the PPP loans, but I'm not certain that they will with this. There is collateral, so that's another difference. A personal guarantee may be required if you are borrowing more than or getting more than $200,000. But the credit elsewhere requirement that I mentioned earlier is also waived for this program. And there's an interesting feature. If you're really being hurt, you need money right away, you can make an application for an emergency grant of up to $10,000. And the generosity of this one is that you make that request, you get your money within a couple of days, and you make your application. And even if that loan application is not approved for some reason, you don't have to pay the money back. That emergency grant is not getting repaid. You may have seen in the other slides a little bit earlier in this deck that there was some reference as well that when you interplay the Paycheck Protection Program with this program, the emergency grant still does not have to get repaid. A number of you, as we understand, may have some sole proprietors or independent contractors, so I wanted to talk about those real quickly here. Sole proprietors and independent contractors are independently eligible to be a borrower under either of these programs. And so if you are in that category, you can go and make your own application for these loans to come to you directly. As I mentioned, payments to an independent contractor are not considered payroll costs for the employer, the payor. This makes sense if you think about it, because if the independent contractor can actually go and make application for himself, herself, and the employer could also make application to cover those same costs, you basically would be paying twice for, in essence, the same economic payroll costs. And then the payroll costs for sole proprietors and independent contractors do include payments they make to themselves out of their self-employment up to the $100,000, as we saw in the other program. And then those aren't the only things going on. So I wanted to touch base in a couple minutes before my time portion is finished up here. In that website that we mentioned, you'll find a lot of alerts that we sent out, pieces that we've sent out, and one of them is it talks about the impact on small businesses of the COVID crisis overall, not just the CARES Act. And some of the things that we pointed out there for any business to think about is what is the impact of this on who I am right now and what my business is. So one of the things we encourage people to do is to check your loan documents. Is your situation likely giving rise to a default or a breach or some sort of a covenant that you might have that you will not be able to meet? A lot of loans have what are known as financial covenants, like certain cash flow requirements or leverage requirements and limitations. Well, given what's going on, you may buzz right through those, and that would be a default and giving your lender the right to declare a default. Or there may just be general material adverse changes type provisions that we're seeing that lenders are looking at. If you've got a disruption that has a material adverse effect on the business, the lender might look at that as a reason to declare a default. And so if you're in that situation, we encourage you to talk with your lender proactively. They've demonstrated some awareness and sensitivity to this, but you need to just look into that. Force majeure. This is a fancy term. I think it came from the French way back historically. It basically means things that you don't really control, acts of God, some of those natural disasters we've talked about, other things that happen are war, acts of terrorism, are all of that. It's uncertain if this would be included as an event which would qualify as a force majeure, but there's a good chance it does. It's very language specific. And so you'll have to look at your provisions carefully. But these show up in your supply contracts, in your lease arrangements, in almost any commercial agreement. There's a good chance that there's a force majeure that says my performance is forgiven or can be delayed if I'm experiencing a force majeure. So if I've got a supply contract to send you the supplies that you need to run your business, and the tornado knocked down my manufacturing site, that would be a force majeure, and I would not be in breach of my contract to you if I didn't deliver on time because of that event. And you may have those that help you out. Is this a force majeure that can forgive your failure to be able to perform? Has it impacted your cash flow, and is that enough for you to be relieved from your obligation to pay rent, for example? And that's, again, very specific language by language, so you'll have to look carefully. Business interruption insurance is something that people are looking at. The insurance industry doesn't like it. There have been a couple of national suits on the national landscape on that. There's some indication of some legislative activity to require the insurance companies to pay for business interruption as a result of this, but there's some resistance. And our guidance here is don't take no for an answer the first time around. It may be that it's not covered, but the easy answer from your carrier is no. So take a look behind that a little bit. And the last one, I don't know the full makeup of what you guys are looking at, but I mentioned this reference to fiduciary duties because there is a responsibility that you have in your companies. Whether you're on a board of directors and you have a board on your own companies, or you have investors that are maybe passive or other partners, that you've got fiduciary duties to those people. And as you're facing financial challenges, the range of those who have a duty owed to them for the decisions you make in addressing financial circumstances can broaden up, and that can include, in some circumstances, creditors. That not only would you owe a duty to your shareholders or to your owners or your partners, but you may owe a duty to your creditors to make good decisions and well-informed decisions. I'm not going to go into that a whole lot further because it gets fairly convoluted, but if you do have a situation like that and want to follow up with us, we'll give you our contact information after, and we can, at least respond and help out on a quick basis. If it runs deeper, then we would have to probably look at engagement relationships with that. So in summary, I'm going to hand this over to Shelley very quickly, and then, as we said at the end, we'll try to take some Q&A. But the payroll program is real strong. You still have time to apply. Talk to your lenders. If your existing lender is there, banks are prioritizing their existing relationships. But if you don't have a lender, then there are other SBA lenders that are still looking for business. And then the emergency or the economic injury for disaster loans are also an alternative. Not quite as good because they don't have that loan forgiveness, but still can be very helpful if you're suffering losses associated with what's going on. And then those last few general business concerns. So with that, I'm going to hand it over to Shelley, and I think, Shelley, you should be able to control the screen as well, I think.
Absolutely. Thank you, Bob, very much. And I'm excited to talk with all of you regarding the second part of this presentation. We're going to dive into some key employment law topics that are specifically related to work slowdown, stoppages, time off. And as I was sitting and thinking of the relevant issues, I came up with essentially 4 areas that I think are particularly relevant. And the first cautionary tale I would give all of you, or maybe it's a reassurance, is that this is a rapidly changing area. The rules, the requirements, if you're feeling overwhelmed and you're feeling like things are sort of shifting sand, that is very much in line with what the reality is at the moment. So we're going to look a little bit at Indiana's unemployment insurance program. Then we're going to look a little bit at the CARES Act in a different focus than Bob's prior presentation. We're also going to look at the Families First Coronavirus Response Act. And then we're going to take a very brief look at the WARN Act, the Worker Adjustment and Retraining Notification Act of 1988. There are lots of acronyms at issue here, but hopefully we can, as we go through, we can sort of navigate these in short order. So let's start with the unemployment insurance program. As you may well be aware, especially if you have businesses that are currently experiencing a work slowdown or stoppage, an otherwise eligible claimant who is laid off, whether that's temporary or permanent, due to COVID-19 likely will qualify for benefits. In other words, the reason for the layoff, if it is COVID-19, likely is not going to kick an otherwise eligible claimant out from benefits. Keep in mind that the Department of Workforce Development, which is the state agency that oversees unemployment claims, makes all eligibility and benefit determinations. So some basics of the unemployment benefit parameters. There is typically a 1-week waiting period that is currently waived. There also is a work search requirement, and that means that you have to be actively able to and available to work, and you have to search for work in each week that you claim benefits. The exception here is specific to COVID-19 related reasons that you are not able or available for work. And it's very similar for those of you who are familiar with the Families First Coronavirus Response Act. It's very similar reasons that would be eligible there. There is some additional flexibility on late applications for unemployment compensation, but you are encouraged to file promptly. The Department of Workforce Development tells you, or would tell you if you were to be able to get through on their line, if you are in doubt as to whether or not you are eligible or whether you are required to wait, go ahead and file your application. Let them look at all of the relevant information and make that determination. If you apply and provide all the accurate information and it turns out you are or you're not eligible, there's nothing, you don't lose anything by applying. So unemployment benefits per week will, the minimum benefit that will be paid per week is $50, and then there is a maximum weekly benefit of $390. But there are some additional programs that layer onto this particular limit that we can talk about a little bit later. And then the calculation is a base period calculation where you look at the first 4 of the last 5 quarters of employment, divide it by 52, and multiply by 0.47. So it is not a 100% replacement of income. It's subject to a ceiling, and then also it's only designed to be a portion of income. One thing to keep in mind, especially in this environment, a lot of individuals are actually not fully unemployed. They may be forced to work reduced hours. And I did use that word forced on purpose because it's important to remember it's not a voluntary situation, meaning, hey, I'd like to work some reduced hours during this time, and then I'd like to also apply for unemployment. The reduction in hours has to be the result of a decision by the employer to limit the number of hours that are available for work. But that benefit amount is going to be reduced by any work done during the week the work is performed. So that means even if you don't get paid until 2 weeks after you perform the work, the week when you report that you have worked and any compensation that is tied to that work, that's when the reduction in unemployment compensation would occur. Keep in mind that all sorts of pay, all sorts of compensation, sick pay, vacation pay, severance pay, payment in lieu of notice, and holiday pay are typically deductible income, meaning that it can affect your benefits. And I think probably the best thought that I would have for people who are personally applying for unemployment insurance coverage during this time or unemployment compensation is I would recommend just make sure you report honestly and answer all of the questions honestly, and then the Department of Workforce Development does its thing and decides, is this chargeable against your unemployment compensation? Will it reduce your benefits in a given week? Now, I do want to make a quick note regarding self-employed and independent contractors. They are not eligible for standard state-level UI benefits. However, there are some provisions of the CARES Act that we will get to in a little bit that they will be able to obtain unemployment benefits when they are working reduced hours or out of a job due to COVID-19. So just a quick reminder that employers, you are required to notify employees of their rights with respect to unemployment insurance. And that can be communicated in a number of ways. Typically, employers will keep this up in their places of employment. I actually pulled this red language off of the Department of Workforce Development website. They had this posted as acceptable language. It doesn't have to be this language, but this language is approved and is pretty near identical to what you might see on an approved poster or other flyer. All right, this, I believe, is one of the questions that was raised prior to this discussion. And the question was, what is the effect of all of these unemployment claims on employers' contribution rates and reimbursement obligations under the unemployment insurance program? Now, if you are an employer, you are one of two types of employers for purposes of unemployment. You're either what's called a contributory employer or a reimbursable employer. And a contributory employer is your traditional sense of unemployment. It's an insurance program. You pay premiums. Those premiums are adjusted based on charges against your, essentially it's like a claim. It's the same process, in kind of generally speaking, is you have homeowners insurance, you have a claim against that insurance, then it might change your overall rating and therefore adjust the amount you have to pay into the program moving forward. One thing to keep in mind, if you're that kind of standard contributory employer, these layoffs that you're experiencing right now are not going to be charged to you individually. They are going to be essentially mutualized, going to be aggregated into one big group, and then they will be charged against the entire employer pool. So it is really the idea of insurance adjusting or assurance risk management at its best, which is that you individually, even if you're really hard hit by this, are not going to be individually charged. If you are a reimbursable employer, these are employers, and it may not be anyone on this call, but these are employers who pay as they go. There are certain employers who are allowed to, nonprofit organizations, government entities, they are allowed to essentially pay on a claims basis, meaning if there's a claim, it's charged dollar for dollar. If I have a $10,000 unemployment claim, it's charged at $10,000. Those are going to continue to be charged dollar for dollar against individual employer accounts. However, because of the CARE Act, the state will actually receive 50% of those charges that are eligible as a reimbursement, and will in turn reimburse those directly charged reimbursable employers. So that relief will be coming there as well. One thing, if you were not aware, your Q1 reporting and contribution payments the deadline for that has been extended to May 31st, 2020. So that means you get an additional month without any penalties and interest or any problems arising from that delay. And then one thing I also wanted to highlight is if you have questions about whether you're an essential business, and I know we're a couple weeks into this, so this may not be something that you're currently struggling with mightily, but if you do have questions for purposes of shutdown and layoff, there is a hotline. This is a business and industry only hotline that you can call, and there's also an email address. I'm going to jump now into the federal realm. And the first federal law that we're going to talk about, which complements and extends Indiana's state unemployment insurance program, is going to be under the CARES Act. And I just want to highlight that the basics of the Indiana unemployment insurance program. There are a lot of resources, and we'll get to resources a little bit later in this presentation. There are a lot of available resources to help you navigate. I would encourage you to essentially ask lots of questions, look at the resources, seek additional guidance if needed. If you're unfamiliar with how Indiana's unemployment insurance program is set up, and here's why. That uninsurance program will help disperse additional federal unemployment insurance resources that were enacted by the CARES Act. So let me talk a little bit about what you can find inside the CARES Act that helps from a work slowdown, stoppage, unemployment perspective. There is something called Pandemic Unemployment Assistance, PUA. This is really critical for individuals who would not typically qualify under Indiana's unemployment insurance program. This is your sole proprietors. This is your independent contractors, people with limited work history. So this is a really important program. And one thing to keep in mind is that in order to receive these benefits, generally, you will go through the state unemployment insurance program. So there was a question that was submitted that said, well, am I allowed to, as an owner of a business, am I allowed to submit my own application for unemployment? And I actually heard this question addressed on a conference call with the Department of Workforce Development. And the answer was, any person who believes that they may be eligible for unemployment insurance compensation should go ahead and submit an application. If you don't know, go ahead and submit the application. You will have to answer a series of questions. Those questions will result in an unemployment determination. And the comment was made that currently, if you are, let's say, an independent contractor, when you complete that process, you will be denied. But your application will remain in the system so that when the Department of Workforce Development goes in and starts making these federal funds available, then that will be available to you. Okay, so that is important to keep in mind. Even if you are not currently eligible for traditional UI benefits in Indiana, you still can utilize the same application portal and just be certain to respond accurately and truthfully to all of the questions. There's unemployment relief. This is actually what I was referencing in my earlier slide, and that talks about reimbursement of 50% of emergency unemployment or unemployment benefits made between March 13th and December 31st. There's also something called federal pandemic unemployment compensation. This is maybe the one that you have heard the most about. This is an additional $600 per week for individuals who are already collecting unemployment benefits. So this is, again, it's very critical to go back to your state unemployment insurance program and ensure that you have accomplished all of the things necessary to file for unemployment. And through that, you will be able to determine if you're eligible for this additional $600 per week benefit. One thing to keep in mind, it does end in the week, the last week ending on or before July 31st, 2020, but it also has a maximum benefit entitlement protection. And what that means is that a state who receives this pass-through of $600 to supplement unemployment insurance benefits can't artificially reduce the state-level benefit to essentially cancel out the amount that you're receiving. In other words, it's $600 per week on top of what you're currently receiving as unemployment insurance. There are some additional expanded benefits. Again, I talked about this in an earlier slide, and when the state enters into, as it has for Indiana, enters into a program to allow payments during the first week of eligibility, a lot of times you have to do what's called a waiting week when you qualify for unemployment benefits. That is no longer in place here in Indiana, and you are actually eligible to receive your benefits as of the first week that you are that you file and are eligible. There also is Pandemic Emergency Unemployment Compensation, PEUC. This is extended unemployment benefits. And so if you are receiving benefits and you have exhausted all of those benefit rights, so you just run out of unemployment, you've been unemployed so long you ran out of those rights, and you also are not receiving federal or Canadian unemployment insurance benefits, and you are able, available, and actively seeking work, same requirement I mentioned before, then you would be eligible potentially to receive the extended benefit amount. Again, this is also a protected area, which says that what's called a maximum benefit entitlement will apply. And that means that the state cannot reduce your overall state eligibility in order to reduce your overall benefits. There is also a program that's offered under the CARES Act that is referred to as short-time compensation, shared work, and work share. Essentially, a work share program occurs when an employer and the state collaborate together to reduce an employee's work hours, but then supplement the lost income through the unemployment insurance process. I will tell you, Indiana does not, to the best that I was able to determine at this moment, has not yet entered a work share program. It is something that is supported by a number of trade organizations, but it has not yet occurred. But it is an option, and there is a mechanism within that law that says, or that portion of the CARES Act, which does allow states who want to start such a program to do so. And then I thought I would just touch on a few other employment-related provisions that sit within the CARES Act. These aren't really necessarily related to work stoppages, slowdowns, unemployment, but I think that they're important from an employment law perspective. Student loan payments. If employers are making student loan payments, though on behalf of employees, you're not going to be taxed for that. So if any of you are an employer or have an employer that is making student loan payments, that is until December 31st going to be a tax-free payment by the employer for the employee. There are tax credits for employee retention. And if you take a look at, this is really targeted to those employers who have been hit the hardest by COVID-19. And there is a refundable payroll tax credit for 50% of wages incurred from March 13th to December 31st for the first $10,000 of compensation, and then employers with 100 or fewer full-time employees will receive credit for all employee wages. There also are deferred payroll tax payment dates, so just keep that in mind. You can essentially make your payroll tax payment due dates to extend to December 31st, 2021, and the other half by December 31st, 2022. And a lot of it, I will tell you, a lot of this content is more on the financial side of things and some things that Bob talked about in his prior presentation, so I won't spend too much time in that area. So let me jump now. So we started with state unemployment insurance. We moved to the CARES Act. Now we're going to go talk a little bit about the Families First Coronavirus Response Act. This act, and two particular provisions that I want to dive into a little bit, talks about new emergency paid leave programs that have been introduced under FFCRA. This typically is for small employers. Small employers is going to be defined as employers with fewer than 500 employees. One caveat, there are different mechanisms that you need to apply when counting employees if there are related companies or potential joint employment relationships. But generally speaking, businesses under 500 employees are covered. I also will add another caveat that there are, in some circumstances, an ability for very small businesses, 50 employees or less, who can claim a hardship in allowing paid leave to occur under these provisions. So if you are a very small business, you may already have gone through the FFCRA adventure of assessing, does it apply to you? If you're small, then the answer is yes. But number two, is do you have an ability to exempt your business from FFCRA's paid leave provisions on the basis that it would create, and it's only for certain reasons. I think that's the other thing to keep in mind, that it would create a financial hardship. You can be exempt from some portions of those provisions. It was effective on April 1st, 2020, and it expires on December 31st, 2020. So let me dive into the two different types of leave that are covered under the Families First Coronavirus Response Act. And I know we're getting really bogged down with acronyms. The first is the Emergency Family and Medical Leave Expansion Act. Easy way to think about this is think of FMLA as it already exists. FMLA now has been expanded, so it has been expanded beyond its original or current status into covering an additional COVID-19 qualifying reason for leave, and that means employees who are unable to work or telework while caring for an employee's child due to school or daycare closing or caregiver unavailability due to the COVID-19 emergency. So it's a very specific use for this leave. It also has a shorter employee eligibility window of 30 days of employment. If you recall, under traditional FMLA, when it applies, an employee isn't even eligible for it for a year. after they start working, and they have to work a certain number of hours to trigger it. Not required here. And then the first 2 weeks, typically 10 business days, are unpaid, and then after that it's going to be paid. The mechanism for paying it is paid at 2/3 of the employee's regular rate for hours the employee would normally be scheduled to work, subject to a total benefit of up to $200 per day and $10,000 for the entire leave period. And then there is also the Emergency Paid Sick Leave Act. So we've got the expansion of FMLA, which just expands a leave program that already exists to add an additional reason and also provide for paid leave for a portion of that leave. The basics of the second type of leave, the Emergency Paid Sick Leave Act, is 10 days of paid leave provided for all employees of a covered employer. It provides for emergency paid sick leave when there's a series of reasons. The first would be the employee themselves is subject to a mandatory ordered or healthcare provider advised quarantine or isolation due to COVID-19. The second reason is the employee is experiencing COVID-19 symptoms and seeking a medical diagnosis. The third kind of box of reasons for the employee is that the employee is caring for an individual subject to one of the above quarantine or isolation requirements. Either they've been ordered by an authority or they've been advised by their healthcare provider. Or finally, the employee is required to care for the employee's child due to the unavailability of school, place of care, or daycare provider due to COVID-19 precautions. One note for the term child, it has been followed up in some of the questions and answers that does not, that also can include an adult child if that adult child has a physical or mental disability that makes them unable to care for themselves. So keep that in mind as well. The totals here up to $511 per day and $5111 total if it's for the first two reasons, which the division here is generally if it's for the employee's own quarantine, isolation, or health condition, then it's full pay. It's 2/3 of pay if they're caring for some other individual or for the individual's child. And there's a series of topics that I'm going to zoom through a little bit because I want to get to the WARN Act, which is our last topic in a timely manner. But so these are some general thoughts with respect to both the expanded FMLA, which is the EFMLEA, and the Emergency Paid Sick Leave Act. The integrated employer and joint employer tests apply, as I mentioned. If someone works a varying schedule, that calculation is available under both. And that means that if someone you can't really calculate, they don't work a regular schedule, so it's hard to tell how many hours they would be entitled to. There is a calculation that's available for that. There's not a ton of guidance. We get more and more every day. There's not a ton of guidance in terms of how to actually implement these in the workplace, if that makes sense. There's not, like you don't have a specific form you have to use that the employee submits to request leave. I would encourage you, not just with this, but generally, as you're making these decisions, use good documentation practices. Require some statement from the employee in writing about why they're requesting the leave and making sure that you're creating a history as to why you're allowing the leave or not allowing the leave. One thing to keep in mind, certain employees are exempt from the leave protections on the basis of being a healthcare provider or an emergency responder. I will tell you, there is a lot of swirling discussion / confusion / angst over what constitutes a healthcare provider and an emergency responder for purposes of denying an employee leave. So all I would say on that particular piece, and the reason for that is that the statute says one thing, the frequently asked questions by the Department of Labor says another thing, and then third of all, the proposed temporary rules that are being implemented say a third slightly different thing. So there's a little bit of uncertainty in that. And so I would say if you're going to deny leave on this basis, make sure you understand the basis and feel comfortable with that basis. There's lots of resources. We'll get to that in just a moment. And there was some clarifying and amending of the Families First Coronavirus Relief Act by the CARES Act. Let's see, there is a tax credit for eligible employers. it's really important to establish that you are an eligible employer, you're a covered employer under this act. And the reason for that is it will entitle you to 100% tax credit for certain covered payments that are made under this provision. And there's also some non-penalty provisions for cash-strapped businesses who choose to withhold certain payroll tax payments, which is also provided elsewhere. There is a temporary non-enforcement period for this particular law, but keep in mind that non-enforcement just means the government agency isn't actually going to come after anyone until the end of that period. That doesn't change the compliance obligation or any private cause of action that might exist. All right, very briefly, let me touch on the WARN Act. There was a question submitted asking, what is the WARN Act? You know, how does this fit into everything else? As if you didn't already have enough to think about, if you are an employer that has at least 100 employees, generally speaking, the federal WARN Act will apply. Indiana does not have its own mini WARN Act. It actually follows the provisions of the federal WARN Act. Generally speaking, if you're going to institute what's called a plant closing or a mass layoff, you need to provide 60 days notice in advance of making those large-scale reductions in force, unless an exception applies. And that's sort of the critical piece here. I can't think of a better example in current times than the COVID-19 crisis and all of the financial insecurities that followed it in terms of not being able to plan in advance. If you think back 60 days ago, who would have thought? Were any of us thinking of that issue? So it is likely that your 60-day notice requirement before any of these mass layoffs may be reduced. You still have to give the notice, but it can reduce the amount of time that you're required to provide the notice. So essentially, the notice contains basic information. When is the person going to be laid off? Is it going to be temporary or permanent? What are the plans with respect to the site? Is it a site closure or is it just an individual employment loss? And speaking of employment loss, there really are only 3 examples of what constitutes an employment loss that will require you to even think about the WARN Act and by the way, WARN Act essentially says that you have to do 3 things. You have to give notice to the employee, or if there is a union, the employee's union representative that describes this upcoming layoff. You have to also notify the state displaced worker unit or the state government, and then also the local unit of government. So you have to make 3 essential different notifications 60 days in advance, or if there is an extenuating circumstance, or if somehow it doesn't constitute a plant closing or mass layoff, then that time could be reduced or in some places eliminated. But essentially, employment loss only occurs when there is a termination, other than a discharge for cause, voluntary departure, or retirement. So if someone resigns and says, "Hey, I'm kind of out," that's not the same thing as a forced separation, an employment termination. A layoff that exceeds 6 months or a reduction in hours of work of individual employees of more than 50% during each month of any 6-month period. One thing to keep in mind, it's a rolling 90-day look back and look forward period. So even if you have an event that by itself doesn't trigger WARN, you can accumulate those events over a 90-day period, and you can have aggregated events that actually will end up triggering WARN. And when that happens, the notice requirement goes back to the first employment loss that occurred under the plan. So one of the last pieces here is there's so much information swirling, is where do you get the most recent and relevant information for COVID-19? And I'm not going to spend too much time on this because I want to get to our questions. But please keep in mind, information is churning out on a day-by-day basis. The perfect example is since I drafted this presentation, the Department of Labor has issued 20 additional frequently asked questions resources on its website as it relates to the Families First Coronavirus Response Act. We learned that this morning, Monday morning at 8 o'clock in the morning, and are now reviewing what that additional guidance is. So keep in mind, it's being updated frequently. I would urge you to take, to the extent any of these impact you and you're monitoring and kind of wanting to know what to do and what the latest news is, set up a defined process. We're going to monitor it in this way, and these people are responsible for it. Check an authoritative and frequently updated source. One of the things to keep in mind is that sometimes frequently asked questions will be answered one way in one area, and then you might have another guidance resource that answers a different question a different way in another area. So keep that in mind and understand that there may be different sources and they may tell you different things at different times. To that point, look for details on when it was updated and the method for communicating updates. Do you know if you're looking at, let's see, the state's unemployment frequently asked questions? I will tell you, they're doing a great job. They have a highlighted banner at the top of their frequently asked questions that says this is the last time it was updated. If necessary, confirm the information among multiple sources. Some you're able to sign up to receive alerts. There are frequently hotlines. I found a number of industry-specific hotlines. One I put in this particular presentation. There are a number of hotlines that are established. Now, how well those hotlines work, I think, is going to be dependent on when you call and how well staffed they are. But State Department of Health has had a hotline that we've had some good results with for healthcare providers. And then if you need additional guidance, obviously seek that out. And with that, I will tell you that I have some other slides in this presentation that contain key resources, but I'm going to actually turn it over. So Bob, if you and I want to kind of run through some of the questions so we can get started with that, and I assume that this presentation will be available for participants upon request following the end of the presentation. So I'm just kind of scrolling through some of the different resources that are available to you in connection with the different topics that we talked about. And I also wanted to highlight, which Bob did earlier, we have a task force that's working on this every day. We're updating and pushing out new information as we become aware of it. And we also have a hotline that's established. Even if it's after business hours or you're not sure exactly who to reach out to, please feel free to call if you have any questions. Then I think we'll transition to answering questions. Let's see, which were provided.
Let me join in just to give your voice a rest and give you a chance to get a sip of water.
Very good.
But
Very good.
There were, as we noted, a couple of questions that came in early. And one of them dealt with the question of sort of entity formation. The person submitting the question recognized that a number of types of business forms were referenced: corporations, sole proprietors, independent contractors. They seem to, and there was not a specific mention, and I concur, I haven't really seen this specifically mentioned. What about partnerships? Are they still part of this mix? And I would say that if you are operating in a partnership, the answer is that that entity would still be an eligible borrower. The SBA relies upon its general framework under the Section 7 program, and it talks about a business concern, and certainly a business concern includes a partnership. However, there also are some issues associated with that become much more complicated, and this is high level, and I can't say that this will be the right answer in all circumstances, but the question is, if you are in a partnership, are you able to include the payments to your partners as part of your payroll costs? And this is where it gets fairly complicated because a partner in a partnership is generally not a W-2 employee. They're more of a self-employed person. And unfortunately, I haven't seen specific guidance on this, but it would be cleaner if you are a W-2 employee. So if you have an S corporation, for example, and you hire yourself, then that's a W-2 employee. But if you're an LLC or an actual partnership, an LLC tax as a partnership, then it becomes more complicated. And it is very possible that the better pathway on that would be to to apply on an individual basis. But as I said, this is, as Shelley mentioned earlier, all this is pretty fluid, even on this side of the discussion that we're having. So that may not be as crystal clean an answer, but that seems to be what it is right now. And another question was, what was the documentation that is required? I did reference that a little bit, that because your lenders need to prepare the application, their own form, and to submit the SBA for the loan to be guaranteed, they're going to ask for certain things, and there is a bit of an underwriting risk that they take. So there'll be a question of things that they just need to have. But the other side of documentation that's very important for you here is when you want to seek loan forgiveness, because I'm sure if you get a loan, that would be a great thing to happen for you. You will need to demonstrate to your lender, and again, remember that you make a request for forgiveness to your lender, and then the lender takes that and submits it and approves it. But you will need to be able to demonstrate to your lender the uses to which the loan proceeds were put. And so you'll need to be able to provide payroll records. You'll need to provide copies of checks if you're writing checks or ACH transfers or whatever your payment methodology is with respect to rent and utilities and mortgage interest. Because in order for that to be eligible for the forgiveness, it does have to be documented. So, one of the questions, well, why are the banks asking for a lot of stuff that maybe they don't really need? It has to do, I think, with the secondary market, and lenders that have participated in this program sometimes have made loans they thought were eligible and were qualified under the 7A program, and then those loans get rejected, and they end up carrying that credit facility on their records when one of their risk elements, their underwriting evaluation, assumed a guarantee under the SBA program. So there is a legitimate reason from their perspective on this. And so, Shelley, I know you had a lot more questions that seem to deal with some of the specifics on the unemployment area, a lot of which I think you answered as you went through this, but do you want to try to address some of those other ones?
Yeah, let me jump in and kind of run through. I was actually, as you were talking, I was kind of looking through some of these questions. I think we can knock some of these out in short order and still stay on track timing-wise. So the first question...
Shelley, excuse me, sorry. I've noticed that our Q&A box has been pretty empty. I don't know if anybody has tried to put it in, but if you have a real-time question, there should be your ability to type in the box and hit the Ask button, and that'll pop up, and Shelley and I will see it, and then we'll decide who can respond. Sorry to interrupt, but wanted to give people a chance to activate that tool if they wanted to.
No problem.
Sorry.
That's a great reminder. So looking at the questions that were submitted, now that all of these were submitted prior to the presentation, there was a question as to whether doctors should file for unemployment until the Paycheck Protection Program is up and running and then hire everyone back. And the answer to that is that you have to make the best financial decisions for your organization based on the information and the resources that are currently available to you. There is no reason that you are prohibited by law if you're experiencing a financial situation that makes you say you feel like you need to shut down. You can institute what's called a temporary layoff, also called a furlough, and that was a question too. What's the difference between a furlough and a layoff? So a layoff traditionally has been you are separated from employment, you lose your job as the result of a reduction in force. There is also what's called a temporary layoff, which may or may not result in you actually losing your job, but it is also called a furlough. And generally speaking, furlough is borrowed from federal employees. Federal employees typically that's kind of where you see it in the language of the laws. But temporary layoff and furlough, when you're talking about them in sort of a layperson standpoint, those generally are the same thing. Now, there are some technical issues because those are also defined terms under certain laws. But if you're talking about someone who says they've been furloughed, usually that means it's a temporary layoff and they expect to be called back at some point. But going back to, can you lay off employees and then call them back when your financial situation changes? Again, I would make the decision that's best for your organization in light of all of the available information. And so if you decide it's necessary to implement a layoff for whatever reason, whether that's because you're not, some activity is not considered an essential, you're not an essential employer, or just because you're having financial difficulties making it through until that act takes place, then obviously you should make those decisions based on the best interest of your organization, and it is not prohibited to have a temporary layoff or furlough. A couple of great questions that I want to handle together. We had a couple of questions about, okay, so we've shut down and our employees are laid off, but they're still doing stuff. Okay, there was an example of a doctor is seeing patients on an emergency basis, or we have office managers that are going in and doing work for a very, very limited time. Couple of layers to this question. The first one is it depends hugely on whether your employee is an exempt or a non-exempt employee in terms of how you compensate that sort of intermittent work. If it's an exempt employee, keep in mind that an exempt employee is entitled to be paid their salary in any week when they perform work. So even if you're only working for a specific period of time, if you are staying consistent with the salary requirements, that kind of the spirit of a salary, that means that it doesn't matter how many hours you work. As long as you are working, you should receive your salary. The second one is if you are non-exempt, then that means you should be paid for whatever work you do. You record it, you turn in your time card, you do all of that, even though you are technically laid off most of the time. And I think what we're describing here really is a reduction in services, not necessarily a full layoff. So it is, it is a layoff, but any week where work is performed, that does need to be reported to the state unemployment compensation program. So any of you who've ever done this before, this may be your first time navigating it, each week you have to fill out a voucher and it says, did you work at all this week? And if so, how much did you work and how much will you be paid for that work? So with respect to, I'll add it, so if there is work done, then an employee does need to be compensated for that work. And that compensation should be consistent with the type of employee that person is. Are they an exempt or non-exempt employee? One thing to keep in mind is that you can temporarily reduce a salaried employee's salary and actually change their salary for a temporary period that says because of the conditions, we're going to reduce your salary and now we're going to have you come in for this many hours per week. But that should not be done on an ad hoc basis. That should actually be sitting down and changing the salary for a temporary period, which can be defined by the employer's documents, like if there's an employment contract, for example. And so I would definitely tell you to make sure you look at your employment contracts to make sure that any sort of changes you want to make, whether temporary or long-term, to an employee's salary or rate of pay are consistent with that document. And then also keep in mind, if you have someone that's determined as exempt employees must earn a certain amount per week, it's generally speaking, to remain exempt. And so if they are not earning, I think it's $678 per week, then they will no longer be considered exempt if you reduce their salary below the minimum salary threshold. One exception to that is optometrists themselves, because they are part of what I think the actual defined term is physician under the exemption rules. The salary doesn't apply to them. So if you're an optometrist, much like if you're a lawyer, you can be paid any amount and still, as long as you're performing the duties of an exempt employee, still qualify for the exemption. So long story short, that is a very fact-intensive question. And so I would recommend kind of thinking out carefully how you would handle ongoing work that's going to be performed during periods of layoff or reduction in force. and then and making sure to communicate that is, any amount that they're earning does need to be communicated in the week when the work was performed.
Hey, Shelley, I've got a question that I'm tying this to another conversation I had on another presentation like this.
Sure.
And it links to what you were talking about with some of the guys coming in and doing some work, but they're really off, but they're really helping out here and there. One of the things that one of our other colleagues, Amy Adelaide, said at one point is that once you do any work, then then that person is entitled to work for the to be paid for the entire pay period. So someone on salary, as I understood it, you come in and you're supposed to be off, but you come in and you do a half a day to do some stuff that's considered a trigger for the entire pay period responsibility. I may not be stating that accurately, but do you know what I'm talking about? Can you
I do.
Respond to that?
Yes, so this is specific to exempt employees. And as I stated, for any employee, if they are doing work in a particular week, then they need to be compensated for the work they perform in that week. And when you have an exempt employee, the whole purpose of an exempt employee is that some weeks they will work more hours and some weeks they will work less hours. And so if they are working during a week and they are a salaried employee, technically they should earn their salary for that week, unless they're doing something like using vacation time or paid time off. In that case, they're already being paid under that provision, and you don't have to pay them extra when they continue to work during that time. But generally speaking, it is a week-to-week determination for salaried employees, and so salaried employees should receive their full salary in weeks when they are working. So that's exactly very consistent with the requirements for that. And then it also has to be reported as income. Like I said, the workaround for that is if you actually temporarily change an individual's salary, you shouldn't dock them salary because you can't. That is a non-exempt activity. You shouldn't dock them salary, but you can temporarily reduce the salary that is commensurate with the services that they're currently performing. But that is a much more deliberate event than, hey, you're only coming in for an hour and a half this week, so I'm only going to pay you, a couple of $50. You can't. That is a non-exempt standard where you would just pay an employee according to the work that they're performing as they do it. But salary, it is a little bit more complicated. Yes. And then let's see. Answer the employment rates will not for unemployment claims will not raise. That is being aggregated as a group. I think they will in the end. Everyone's rates probably will go up, but not individual employers will not be charged all of the unemployment. If the doctor/owner is part of the payroll, should they too claim unemployment? This goes back to my earlier comment, which is this. Two things. First of all, the Department of Workforce Development encourages individuals to apply, and they can make the determination as to whether you're eligible for benefits. And it's doubly important right now because it's possible that you are not eligible for state unemployment insurance benefits, but you may be eligible for some of the expanded benefits that are offered under the CARES Act. So I would say even if you know you will get denied, and even if you get that initial denial, go ahead and answer the questions and work through the process. If you feel that you should be eligible under might potentially be eligible under these alternative programs. Had a question about an employee made a personal decision not to work since her children were no longer in school due to COVID-19. She then did not show up on a Saturday. And so this is where it becomes really tough as an employer. From an employment standpoint, just because we are in this really unprecedented time doesn't mean that general employment policies go out the door. It's so important to be flexible and understanding, but at the same time, if someone is choosing, for example, hey, I don't feel comfortable coming to work. If there's no other reason other than I just don't feel comfortable being at work, that's not the same thing as being laid off. And it also is not a protected reason under these new paid leave provisions. The caveat to the question that was presented is this person has children who are no longer in school due to COVID-19. In my mind, that raises at least the possibility, if there is a protected reason that someone is unavailable to come to work and has requested a leave pursuant to that protected reason, even if it's not perfectly done, even if it's, even if it's really difficult to make that that assessment, I would urge employers to think about, are you covered by the Families First Coronavirus Response Act paid leave provisions? And if you are, I would look at, is it possible this individual may be entitled to leave under those provisions? On the other hand, just because that's, not everyone is entitled to that unless they are actually eligible. Here's a good example. There was a frequently asked question, well, what if someone else is available to care for the children, but I prefer to stay there as well? Like, say there's two parents in the home and one parent is there and available to care for the child. The other parent then therefore is available to work and wouldn't be eligible for leave, protected leave under that provision. But that's the one caveat. If someone is choosing not to come to work or voluntarily resigns and doesn't have leave available to them, then that is a voluntary resignation, and it would be treated as such under any applicable law. If, however, they're attempting to assert a protected right, such as the right to this paid leave due to caring for a child, and you're an employer that's subject to that law, I definitely recommend at least working through that process before taking further action against the employee and determine, is it possible they could get some of this leave and then arrange to come back? Or ultimately, if they're not entitled to it, or they have flagrantly disregarded their obligations to notify in connection with it, then, it turns into just it's what you would do with any employee who's a no-call, no-show or fails to show up in any given context. Let's see, we've got just a few minutes left. Difference between furlough and layoff, we talked about that. Here's a good question. So the question was, when you have this ongoing need that we were talking about for people to provide temporary, like reduced services, can you do that? Yes, absolutely. So someone can be partially unemployed. Now, it will affect the amount that they are able to earn under the unemployment compensation statute, because remember, any week where there's work performed, not the week that they're paid for that work, but any week when there's work performed and they earn compensation, that compensation will apply against their unemployment compensation. And again, going back to what we talked about before, is if you have a salaried employee, unless you are changing that employee's salary, they should earn the full salary in the week that they're performing work for the organization. But yes, I would say absolutely. If there's a reduced or kind of a way to reduce the amount of work, temporarily reduce salaries, and then apply for unemployment insurance, or unemployment insurance benefits, I think that's a good way to proceed. WARN Act, we talked about that. And Bob, I see that you had a note on the question about the who should we follow in terms of whether to open our business, CDC, governor, mayor. Since we just have a couple minutes, I'm going to let you jump back in, and then if I have any follow-up questions or comments, I'll make them.
Yeah, I'll jump in and bring it to a close as we're just at the end of our hour and a half. And so the quick question that we were asked is, who wins in a battle between CDC and the governor and a mayor and so on? And that's a very difficult and complicated constitutional law question, so sort of well beyond this. But in general, the higher up the ladder you are, the more you have control. And so the federal will control the state, and the state will control the local. But it's also possible, because they're also designed to work together, and there are things like state recognition and certain areas that the states have supremacy in. It's almost, the most protective guidance is probably what would be the safest to follow. So when you're dealing with things like, am I an essential business, for example, there are some differences in the way in different approaches that have been taken. And we were dealing with one where the county had a different approach than the state had. So which one do they comply with? So whoever's higher up the ladder is the one that will control, but also the most I guess, flexible one or even the most stringent one, depending which way you're looking at it, will also probably be controlling. So that's a good non-answer to a difficult question. So not to play lawyer too much, but sometimes that's what we do. So we're at 3:30 now. We don't see any questions in our queue, but certainly still send them in, and we'll try to find a way to get a response to you. And then also our information's there. So as we've said, we're happy to help out as we can. Shelley, thanks very much. Dave, are you taking this over to close us out then? Is Dave still on?
Yes, sir. If you're ready to conclude, we can end the call.
Yep. Well, thanks, everyone.
Thanks, everyone.
Ladies and gentlemen, that concludes the Indiana Optometric Association webinar. You may now disconnect, and thank you for joining us today.